Today, I'd like to tell you about our sponsor, Swan Private. Now, you know from listening to this show that our money is broken. Fortunately, we have Bitcoin, a better money that will help us build a brighter future. But if you don't have a Bitcoin strategy and a trusted partner to help you execute that strategy, then you're probably going to fall behind. Now, I've known the Swan Bitcoin team for years. The Bitcoiners at Swan are mission-driven and have deep expertise and respect in the Bitcoin space. In my opinion, this is the team you want on your side. Today, I'd like to highlight Swan's Private Client Services division, which guides high net worth individuals and businesses around the world toward building and preserving wealth with Bitcoin. So visit swanprivate.com and learn how this concierge service gives you direct access to your dedicated Bitcoin advisor by phone, messaging, and email. Swan will guide you on complex areas such as self-custody, or you can choose to hold your Bitcoin through Swan with one of the largest US-regulated custodians. So, make your first purchase with Swan Private and get $100 of Bitcoin. Just tell them that I sent you. You know, an opportunity like this to build and preserve legacy-impacting wealth for your family and company will not likely be seen again in our lifetimes. Sign up at swanprivate.com today, mention Breedlove to your advisor, and get $100 in free Bitcoin when you make your first buy.
On the point of moral suasion, I'll read this excerpt here. The authors write, quote, "The combination of controlled interest rates, capital controls, directed credit," I'm not exactly sure what directed credit is, so maybe you can tell me, "and persistent positive inflation rates is still a mechanism for reducing domestic government debt in the world's second largest economy, China. More broadly, we document how in the post-crisis debt-laden environment, financial repression has once again resurfaced in its many forms among the advanced economies through a variety of regulatory changes, implicit or explicit, nominal interest rate ceilings, and in some cases, capital controls and quote unquote moral suasion to induce domestic institutions to hold more government debt." So that was kind of laying out the different forms of financial repression. And I think the paper goes on to detail them more a little further. My question was on, well, one, directed credit. Maybe if you know what that is. I don't exactly know what that is.
Offhand, I think I know what it refers to in either way. It's an important term to go over, an important concept to go over, which is when the government can incentivize lending for certain purposes more so than others. So, for example, in theory, you could put a tax on lending for certain things. Let's say I want to open a liquor store. They could add frictions to do that. Okay. Or let's say when U.S. veterans were coming back from World War II, part of the GI Bill was that, they put them through college and things like that, but then they also gave them loan guarantees if they want to like buy a house, for example. And so they didn't outright give them the money to buy a house, right, but they would backstop loans to them. And so they would make their loans basically risk-free for a bank to lend money to, and therefore they would effectively lower the cost of credit because they judged that, and most people, of course, agreed at the time, is they judged that as a useful, a societal good,
right? Okay.
For those people to be able to buy homes cheaply. And so directed credit, I think that's what it refers to. And if not, like I said, it's still an important concept to go over, where the government uses the fact that it can print money and backstop loans, or in theory, add frictions to loans in order to make it easier for certain groups to borrow money cheaply. And so that goes back to the Cantillon effect of who gets access to cheap credit, who does not.
Right.
And so partly it's based on how,
and which industries benefit too, right? Because you can direct cheap credit to build a house, but maybe not to build a liquor store. So
exactly. Yeah. You want veterans to have houses, but let's say you don't want liquor stores, or you're in the middle of a war and you want to say, okay, we're going to pay up front, we're gonna do various loan guarantees to go build industrial facilities because we got to make airplanes, we got to get commodities. Let's say you have an energy crisis and you say, okay, we're going to backstop loans to energy companies. And so you can imagine how this can be used for good or ill, depending on what society is structured around.
Yeah, well, there introduces a lot of ambiguity here too for politicians and rhetoricians to say what's good for society versus not, and it might actually be good for them or their buddies or their pocketbook rather than good for society. But yes, important concept. On the moral suasion component, it seems like, so I guess the common denominator between all these modes of financial repression is getting domestic institutions to hold more government debt. I'm sorry, maybe that was specific to the moral suasion piece. Maybe I'm reading this wrong, but so the incentive here is basically government is trying to create, if we just focus on moral suasion, they're trying to do this guilt trip, patriotic slant, if you will, on getting institutions to hold more government debt, which is to create more reservation demand for government debt and give it more economic longevity, right? Or more liquidity or runway, whatever you want to call it. Is that correct? Is that basically the approach that's being used here? I mean, why else would they want domestic institutions to hold more government debt? It's to extend the solvency of the government, basically, right?
Yeah, basically it keeps their rates low while minimizing how much they have to outright print to buy it. And so, for example, if all they do, if they run out of natural buyers and they want to hold interest rates, let's say you're Japan and you have 250% government debt to GDP, you can't let interest rates go very high, otherwise you're going to be outright insolvent. And so you say, okay, we're going to hold interest rates near zero. Nobody wants to hold these bonds, so we're going to have the Bank of Japan buy them all. That's going to be more prone to inflation, or in the long run, potentially hyperinflation, if there's no other buyers for those and they're just literally outright printing money. And so you say, okay, how can we slow that down? How can we create some actual buyers for these bonds? And so you can say, okay, well, all pensions have to own, for their own safety, you can say they all have to own 20% of their assets in Japanese bonds. Or you can say, banks have to own 20% of their assets in bonds. And then, to the extent that you want to get the public involved, that's obviously harder because, again, the number of enforcement points. But let's say in World War II, you'd have war bonds. You'd say, okay, it's literally if you want to help us win the war, buy these bonds. And so that's a way for, people could contribute to the war and help keep financing costs low. And of course, it depends on where they fell on that. They'd lose money, but people can say, well, at least they won the war. But that gets basically you're relying on that patriotic duty.
Yeah.
And again, it goes back to the more desirable your society is, the easier that is to do, because you say, well, we want to win the war, versus if you're on the other side of that,
right,
and there's maybe more people that are questioning the ethics of the war. If you're the aggressor, or you're not in the truth, that's going to be harder to get people to buy into those bonds. And so that's going to be much harder to do.
This is back to that, just creating captive audiences, right? Or to force pensions or endowments to be 20% invested into government bonds, that then gives them a channel to implicitly default through some of those capital pools, right? So they can basically tax them to, what was it called earlier? The financial repression tax, that this gives them some surface area to impose that.
Yes. And part of the thought process there, when they try to structure these, is if they're saying, okay, if we're going to print a lot of money, banks are going to benefit from this because their deposit base is going to go up a ton.
Right.
And of course they get a small margin on their deposit base.
Yeah.
So if we double the money supply, banks are going to be happy because they double the deposits.
Right.
And so they say, well, since they're getting the benefits, we're also going to put a lot of the burdens on them as well to try to balance that out. So we're going to say, okay, your deposits are going up a ton, but you have to hold a lot of those assets in our government bonds, which we're financial repressing.
Right.
And so we're kind of taking back those excess profits that you would have gotten from our money printing, as the banks are near the center of the Cantillon effect, and we're going to take some of those back. And so that would be the kind of the sophistry behind why them, and it's basically much easier to sell the notion that those benefiting from it are going to be the ones repressed than, putting that on people that are not benefiting and being repressed, because that's the
Right.
worst of all worlds. So yeah, that they, of course, also the more sophisticated way of doing it, the less likely you're to get unrest or harsh pushback against your financial repression plan. The more it seems to make sense to people. I mean, a lot of it's opaque, obviously, but
Yes, right.
to the extent that it's transparent, the more it seems like it makes sense, and the more, again, that the more desirable that place is to be in, where people like kind of understand what's going on here, the easier it is to do, versus the more ill-structured it is, the worse the incentives are, the more corrupt. If you're literally just printing money and then giving it to your
Right.
buddy, um, and there's there's multiple degrees. I mean, one of the challenges, going back to directed lending, was during the the lockdowns, you did the PPP loans. That was an
Right.
example of, they would have these loans that turn into grants. So they use the banking system, because the government doesn't have these arms where it can just
Yeah.
go out and make, millions of individual loans.
Yeah.
So it has to use the banking system. And so it backstopped these loans and eventually forgave the loans. And the problem there is, some people, of course, you know, benefited from them, because if you have a restaurant and you're really not allowed to have customers and you're going to go
Yeah.
insolvent because you still have to
Right.
pay your bills, that keeps you solvent. But there was like literally companies like financial asset managers that apply for and receive those PPP loans. They had no plans to lay people off.
Mm.
So all that money just goes to the bottom line of the fairly wealthy business
Mm.
owner, and then those get forgiven. And that's an example of, very, most people would agree that it's not a good form, right?
Right.
So again, the further you get away from it making sense to people, the more likely you are to get pushback or questions around, how, or also the more likely you are to get inflation, because if you're just literally, creating money almost for the
Helicopter
sake of
money
creating,
at that
yeah,
point. Yeah.
yeah,
Yeah. Yeah. To your broader point, I mean, just shrouding all of this in increasing nominal values seems to be a really effective illusion. People just think that I mean, we see it now, right? People got checks for whatever PPP loans or whatever government handouts there were. Well, now we're experiencing the inflation of that. But again, rhetoric out of the White House never says that. It's never like, oh, we sent you checks and now there's inflation. It blames everything else. And people,
yeah.
I guess a general ignorance of all of these topics and money itself lets that work, right? It sort of works. People
And
at least
and
partially believe it.
yeah, and recency bias. When you have
Mm.
decades of disinflation, we had a number of disinflationary drivers, right?
Mhm.
Because, for example, we had globalization. So we had the
Mhm.
opening up of China and former Soviet Union states to the world, this
Mhm.
big untapped pool of labor. Developed countries could, you know, push some of their costs onto that.
Mhm.
And so it's basically a enhancement of productivity, enhancement of organization for the world.
Yeah.
And so that was a big release valve for
Yeah.
inflation for a long time. Um, Also, throughout the 2010s, you had, especially in the second half of it, you had commodity oversupply, partly due to the
Mhm.
ramp up of shale oil, which partly was based on cheap credit. Basically, it is unprofitable oil, but it did ramp up, and it kind of distorted supply and demand. You had slow growth, so you had slow demand growth, in part because of how the money system structured. And so we had this period of relative disinflation. And that gave a lot of academics and a lot of economists this recency bias. And I think that they didn't have the right models for what
Mm.
causes inflation. And they also mix up base money and broad money. And so they said, well, we did a lot of QE in the 2010s and we didn't really get a lot of inflation. So this won't be inflationary. But of course, there's a more direct transmission mechanism when you do fiscal stimulus.
Right.
And to, you can also go back and ask, was this inevitable to some degree? And back in 2019, I was writing like, okay, so are we in a bond bubble? Because, inflation seems super low right now, but, next crisis, they can just print a lot of money. And because debt's so high, referring to that long-term debt cycle thesis, when you have 150% debt to GDP and there's some sort of disruption in the economy, they can kind of let things play out. But when they build up 350% debt to GDP, in terms of private and public debt,
Mhm.
the time to insolvency when there's some sort of disruption is much tighter.
Mhm.
And so that you can expect that the response time of money printing is probably going to be faster.
Right.
And so one of the things you get in these long-term debt cycles is periods of rising populism. So it's the incentive structure around printing,
Yeah.
where, in 2008, 2009, they bailed out a lot of the banks. They recapitalized the banking system, but they didn't really bail out the homeowner, right?
Yeah.
So a lot of
Right.
homeowners, so homeowners had worse, basically socialism for the rich and capitalism for the poor.
Right.
And so that caused, rising wealth inequality, I like to use the phrase wealth concentration
Mhm.
rather than wealth inequality, because we shouldn't expect wealth to be equal, but
Right.
when you start to get extreme wealth concentration, you have to start asking why, or what's wrong, or what's causing it.
Right.
Is it related to corruption? Is it related to things that can be controlled?
Mhm.
And so we had this period of kind of socialism for the rich and capitalism for the poor. And then so when it came time, when we had that rising populism, that kind of rising stagnation, and then we're all this debt in the system, and then we're impacted by pandemic, and then the lockdown response, and the tolerance that people would have for a second round of that was almost none. And that's why you
Right.
had things like stimulus checks and child tax care credits,
Mhm.
where that's not the thing I'm actually going to freak out about, because it's almost like inevitable.
Mhm.
It's almost like the least bad form of money printing if you're
Right.
actually going to. It's so the way I describe it is that if you run the numbers, there's something like $6 trillion in money printing in the United States in the past, since the start of 2020,
Mhm.
and it comes out to something like $46,000 per American household.
Right.
And it's like, how many households, like if you go to household by household, it's like, do you feel like you got $46,000 worth of direct or indirect stimulus? And it's not really, and it's because they got a token amount,
Yes.
and then everything else, it went, like I said, there's PPP loans that turned into grants,
Yeah.
including for people that didn't need them, wealthy business owners.
Right.
It went to corporate bailouts.
Mhm.
You could have had, if you have companies that face insolvency, it doesn't mean necessarily they get their assets liquidated. It just means that the bondholders take over operation from the equity holders.
Mhm.
And they could have
Mhm.
let that play out for a number of companies that were, you know,
Yeah.
running without kind of a reserve, but they didn't. They bailed them out.
Right.
And so we've kind of set up the structure where, like, let's say you're an airline, and if you know for a fact in recessions you're going to be bailed out, there's an incentive then to not hold cash. To any cash you get, just buy
Right.
back your shares and do this, because if you're the dumb one that actually holds a lot of cash and the cash
Right.
is not keeping up with inflation, you're losing out on your competitors are going to take market share and expand
Right.
and be more aggressive, and you're going to be the dumb one holding cash. And then when it comes time for that cash to actually make sense, if your competitors get bailed out and you too,
Yeah.
you're like, why did I hold cash? And so then the incentive structure is not to hold cash.
Yeah.
And so I think that it's not just the size of the stimulus, it's also where it went to. And one reason, in the 1940s, we had a lot of inflation because of the war spending. But the one positive thing you can say about it was that a lot of it, went towards manufacturing facilities, better technologies,
Right.
getting the 8 million, something like 8 million soldiers came back and they were sent to technical school or college. So you had a more productive workforce.
Yeah.
And so actually after that period of inflation, it was kind of like if you were to describe what MMT people want to see, that's kind of the best example you get out of it. Whereas most, that's kind of the high bar.
Yeah.
And then everything else is usually a worse form of that. Usually you have more corruption, more malinvestment, and a lot of money created without a lot of, good coming from it.
Yeah, I'm glad you brought up the point about the households, because I saw similar math. It was like 46,000 per U.S. household, and then if you polled each household, they probably got what, $4,000 to $6,000 in direct stimulus, something like that.
It would depend. Yeah, they would get some stimulus checks, and then they get child tax credits. And then you could say a couple other things, impacted them indirectly to some extent.
Yeah.
But even if you're being generous with the highest end estimates,
Yeah.
you call it 10,000.
Right.
What happened to the
Less
other
than
36?
a quarter. Yeah, exactly.
Yeah.
And this idea of all of this government intervention actually inverting timeless economic wisdom, right? Holding cash for a rainy day. That's what cash is, basically your buffer against uncertainty. But if you get this recurrent government intervention that's always bailing you out, then you end up like the airline holding no cash. You start penalizing prudence ultimately. Like if you're a prudent business operator holding cash, well, your competitors that get bailed out, you as well, they will outcompete you for being less prudent. It's madness.
And this actually extends internationally as well. And it goes back to the philosophical question of was this inevitable based on the order of technologies? Because let's say you have two countries that are not on friendly terms. And one of them is like, we're going to practice fiscal prudence and austerity and let recessions play out. And the other one's like, no, we're going to like shortcut recessions. So let's say there's some sort of external shock happens. There's both countries encounter recessions. One of them gets over it quicker because they print money. Well, they're at military advantage compared to the other one. And so at least in the short term, basically long term only works if you actually get to the long term.
Yeah.
If the other one prints and buys the commodities, they can actually, the funny is they can, if some country's doing austerity and another country is not, and they print a lot of money and buy a lot of commodities, they can push inflation onto the country that's, trying to be more prudent and be more market oriented anyway.
And as long as they have captive audiences and capital controls to restrict people, because the people getting inflated would want to get out.
Yes.
But if they can impose that restriction, then it works.
Yes. And then both countries end up with inflation. Maybe the one country has more inflation, but they also have more stuff that they got quickly before that inflation really kicked in. And so I think that goes back to the question of, out of 200 countries, why don't you see a gold standard today? Why don't you see, the countries doing this? Why did no one kind of stick to their guns on this? And it's because the incentive structure of the order of technology that we encountered, the fact that commerce moved more quickly than money, just opened up so many both internal country by country arbitrage and then inter-country arbitrage. So that even a group of people that wanted to do the quote unquote right thing would have a hard time doing it. I think there's a quote from the humorist Jack Handy that goes something like, I can imagine a world with like no war. And I can imagine us attacking that world because they'd never expect it, and it's like, I can imagine like a country that like stuck to the gold standard this whole time and it was like super prudent. And I can imagine us like printing money and like buying all the oil and giving them inflation anyway, because what are they going to do? and so it's just this environment is, it's kind of, it was asking for it just because of the order of the way the technology developed. And it's unfortunate in many ways, obviously, especially if you were not at the center of the system, if you were not in the United States, if you're not in Europe, if you're one of the, billions of people living under, half the world lives under authoritarianism, according to Freedom House. Billions of people live in, they have emerging market currencies that every generation or so, or every 2 generations get hyperinflated. And so if you're in those environments, the fact that it turned out like this is terrible. It's both the accident of history and it's to some extent the ordering of technology that we encountered, and then the game theory that arose around that.
Yeah, it's a superb point. And I wonder if it's related to, another guest of mine made this point it's in the Twilight of Gold series, that fiat currency sort of makes your domestic monetary policy vulnerable to the monetary policy of your craziest neighbor. So for instance, if you start debasing currency to wage war and you're that honest, austere, free banking society, well, they're probably going to kick your ass because their war chest is the savings of the whole civilization, right? They can hyperinflate basically and confiscate all that wealth to wage war. Whereas your war chest, if you're an honest government, you would just have your own balance sheet, basically. So it's weird. There's this weird, I guess, accident of history, as you call it, that somehow commerce outpaced the money. Then we sped up money, but at the cost of speeding up money, we introduced a lot of counterparty risk, arbitrage risk, whatever you want to call it, the corruption of money. And then that leads to all of this Band-Aid and duct tape, putting all this stuff back together. And man, what a weird What a weird thing we've just been through the past 150 years and are going
Yeah.
through.
And the whole petrodollar eurodollar system. I know you had Jeff Snyder on one of your shows.
Yeah.
That whole and he's described how clunky that system is. I mean, it's just really opaque, messy market that arose during and after the Bretton Woods system. And that's in large part just because, so gold had shortcomings of, divisibility, auditability,
Mm-hmm.
and then, especially salability across space. And then fiat, of course, has shortcomings of its, stability across time, shortcomings of its auditability, and just various shortcomings. And so the fact that we could have this situation, just this messy, opaque global market of kind of fractional reserve banking is just an inherent limitation of our money. That we don't have a money that checks off every single box of what we want money to do. Each type of money just has, enough of the boxes checked that it's workable as money, but it's not perfect as money.
Yeah.
Like the perfect form of money would be like if you could just mentally teleport gold to each other and, and never forget your password. Or let's say you have Bitcoin and you just say you had your private key, you can never forget it. And you just have no limitations with it. And of course, we can never have perfect money, but you can get closer and closer to the Platonic ideal of what money is with better technology. And so you can, to the extent that Bitcoin continues to be successful, it's closer to the ideal money than gold was, assuming it can be, it can hit some sort of critical mass in terms of liquidity and unstoppability.
Right.
It gets out of its nation stage and into its, basically if it can avoid being killed in the womb.
Yeah. Well, that's such a great point. Almost like the perfect money would have the most frictions to involuntary exchange, whether it's inflation, confiscation, taxation, but minimal frictions to voluntary exchange. So if your country starts inflating your currency and you want to get out of there, or they start being oppressive in whatever way, financially repressive in whatever way, you could just port that money out somewhere else. Really interesting points there. What are the odds that Coinbase could blow up?
So I haven't dug into their finances in detail, but I would describe an outright blow up as probably unlikely.
Oh.
But I think that you can be certainly crippled. You could be permanently smaller. There are a number of crypto companies that are, say the private ones that are having down rounds in terms of valuation, where they might not go bust, but their equity is diluted. They're smaller.
Yeah.
And so that's a different type of blow up. So far, a good thing to see is that Bitcoin companies have gotten through this, this troubled market better than these broad crypto companies.
Right.
You weren't seeing like Bitcoin companies put their names on stadiums and they were much more subdued with their marketing because they're less, just the product kind of sells itself.
Yeah.
And they were focused more on utility in general, so less on speculation and more on making Bitcoin easier to use and doing more things with your Bitcoin, rather than just different types of yield casinos.
Yeah. It does feel like kind of some justice to some extent, at least. Okay. I think we got to page 7, roughly. Okay. What do I want to stop? Okay, I'm going to read this excerpt from page 7 of the document, and then I'll ask you a question about it. So the authors write, through extensive documentation of the regulations covering the financial and external sectors, we also trace out the evolution of quote unquote captive domestic audiences, where these debts are placed, which are an integral part of limiting tax base erosion. Finding high yield alternatives to government debt, Saving vehicles in the era of financial repression was no easy task. Capital controls kept many potential high-yield investment possibilities off limits, while available domestic alternatives offered even more unattractive yields than government debt. So, again, these means of financial repression are basically machinations by which government is externalizing their default onto market actors or capital holders. These necessitate, like, for the government to be able to perpetrate that, they need to be able to stifle and silo the free flow of capital. So, to what extent do you think that is possible in a world where Bitcoin is the dominant money? Like, how much, I know this is a big unknown, so I'm obviously not going to hold you to it, but how much does Bitcoin's ascendance to dominant money circumvent or otherwise make less useful capital controls and these other means of siloing and stifling the free flow of capital?
So if Bitcoin gets past the whole critical mass, it becomes widely adopted. I think it does make it much harder to do that. And this in that sense, it's not unlike other asymmetric technologies of history, right? So for example, gunpowder quickly changed the utility of castles compared to what their use had been for a very long time. And land-based defenses were overcome by air, air weaponry. And so there's technologies that are asymmetric in the sense that they render obsolete or nearly obsolete older forms of technology. And then ideally you get technologies that are, they asymmetrically favor the defender. So encryption is a type of that, where it's much harder to try to attack encryption than to use encryption to defend yourself. And that's basically what one of the premises that Bitcoin is based on. And so part of that is not even fully proven, right? So encryption, the way the encryption is tested over time is they prove it the best they can, but then they have to let it mature and to see, can it, for 10 years, can anything attack this thing? But you never fully know if encryption is entirely bulletproof. But yeah, to the extent that technology continues to work fully as expected, and to the extent that Bitcoin reaches a wide level of ubiquity, and that the people building on it continue to make it easier and easier to use and self-custody and transfer. Because that's a key important. Again, going back to gold, the more frictions that the gold had, the less likely it was to be, not defeated by fiat.
Right.
And same thing with Bitcoin. The less frictions there are with Bitcoin, the more likely it is to succeed. And that's why I think the companies working on it are key. This is not just something, it's not just inevitable. It's not something that just works itself over time. The incentive structures are aligned. The technology, I think, that it's like the right technology for the right time is there. All the ingredients, I think, are there, but it still has to, the football has to be brought across the end zone.
Right.
And so, but if you get there, I think that represents another form of asymmetric technology. And, going back to the coercion argument, you can argue, you can argue that government taxes and things like that are coercive, but you can also, and financial oppression is coercive, but you could also argue that if someone's free to leave, then it's not coercive, or at least it's less coercive.
Yeah,
and so
the power to say no kind of delineates, right? If you have the ability to say no or leave, then technically it's not coercive because you have an exit option.
Yeah, and so we can describe governance. Governance like fills vacuums wherever there's there's no governance. There's going to be some sort of structure for how things are handled there. At the extreme case, if you have ungoverned space, you'll have warlords run it.
Right.
And to the extent that there's government, we ideally want ones that we have more control over, that are given constraints to be more benign.
Yeah.
And so, for example, I'm in a homeowners association. They say you can't have solar panels on your roof, and so I can say, well, that's stupid. I want to move out, or I can say, well, that's acceptable. I like the area, and so whatever.
Yeah.
And so obviously, if you're in a country, it's much harder to leave. It'd be more burdensome to leave, and you'd have to find someone else that is willing to accept you. And so it's for very large countries where people can't just leave. You can it's arguably unethical to have a lot of constraints on their behavior. Whereas smaller ones, you can say, well, it's kind of this voluntary thing that people are doing. And to the extent that money's more portable and self-custodial, in theory, it increases people's mobility to move around their own assets and have more selection on where they want to be. And,
vote with their feet.
Exactly.
Yeah.
And one of the downsides is potentially that it, basically means that the rich have more mobility than the poor. That's already the case and potentially could be more the case. So, it might, just like how gold had externalities that were not necessarily great, there could be some externalities of Bitcoin that, maybe don't work out exactly how we envision or how we'd hope. But, I still think it's a step change improvement compared to the prior monetary technologies and the prior technologies that it's inherently more decentralized. And I think it's, like I said, I would just describe it as the first time where, or at least the first time in 150 years where the speed of money as a bearer asset is caught up to the speed of commerce. And so that does, in theory, reduce the arbitrage that can occur between that money and that commerce.
Right. Yeah, that's a really brilliant point.
Now I'd like to tell you about a great new Bitcoin show on the scene that you've got to check out. Brought to you by Swan Studios and Bitcoin Magazine, this show is Hard Money with Natalie Brunell. Natalie is an Emmy-nominated journalist bringing unparalleled experience to the Bitcoin media scene. And personally, Natalie is one of my favorite voices in the Bitcoin space. Each week on Hard Money, you'll get the top headlines of the week with analysis you won't find anywhere else. Hard-hitting interviews with amazing guests like myself and other top minds in the Bitcoin space. And the show will take you directly into the lives being changed by Bitcoin all over the world. Check out Hard Money at swan.com/hardmoney. Today, I want to tell you about our sponsor, Crowd Health. So, how does health insurance work? You send an egregious amount of money to an insurance company. They hold it in a pool of depreciating fiat currency. Then, when you have a large health event, you have to pay them even more via your deductible. And then you hope they will cover your bill. And in fact, 1 in 6 bills are denied by healthcare.gov plans. It's time to take control of your own healthcare bills. I'd like to introduce you to Crowd Health. It's a decentralization of healthcare using Bitcoin as an alternative to health insurance. Instead of sending fiat currency to a big corporation, you send that money to an account controlled by you, a portion of which is converted into Bitcoin. Then, if you have a big health event, you have a community of Bitcoiners that will use the money in their accounts to help you out. To get more details, go to joincrowdhealth.com/breedlove, where you can find the promo code for $99 a month for 6 months.
Do you then think that in a world where it's much harder to ring fence money, the flow of money in particular, this Bitcoinized world, governments would ramp up taxation, regulation, capital controls? Well, I guess capital controls don't apply here, just taxation and regulation on physical or real assets? I mean, they kind of would necessarily have to shift gears towards things they could enforce on, right?
So you would think that the more self-custodial money is and the more private transactions are, the harder it is to tax things like transactions or income.
Yeah.
And so you have to tax other things. And, again, there's recency bias. So today we take it for granted that, because of the way money works, it's easy to surveil most types of income because, we're not really in a cash-based society anymore.
Yeah.
There's not much, you don't really get much privacy with your transactions. And so it's relatively easy for authorities to determine roughly what someone made and what they owe in taxes, and to just have more points of enforcement. If you had more privacy technology and more self-custody, especially those two together, it does become challenging to determine what someone owes. Let's say there's a billionaire and he's trading cryptos around and he's doing it, all sorts of technologies that makes it hard to determine. It's very hard for the IRS to determine what he owes. And if they even if they think he owes something, how do you really prove what he owes? So if that became widespread, you would think that taxation would have to shift increasingly towards property, real estate, especially non-mobile property. You could potentially go back to more excise taxes, basically the types of taxes that existed in kind of the pre-telecommunications phase, where excise taxes and property taxes and things like that, where when there's large purchases at point of sale, vehicles, imports, those types of things you'd expect to be the points of taxation, because they're the ones that are still fairly easy to track and prove and surveil.
So if that's the case, then the government has to kind of shift towards these specific, typically immovable assets to tax. I mean, what I'm thinking here is government would have to shrink to some extent, because even if they shifted all of their exactions of tax if they concentrated all of their exactions of tax to physical and real property today, that would mean the tax rates would be, very high. Whatever your property tax goes from 3% to 30%, something like that. You're then creating incentives for people to not own that property, or you're lowering valuations and you're incentivizing them into, this ungovernable monetary property. So doesn't that mean that we would expect revenues of governments to shrink just by virtue of this capital control resistant money existing? Or is that too much of a stretch?
I think it's a reasonable thesis. I think if you can argue that if it's that widespread, it is harder for them to be quite as big as they are now, especially things like military endeavors, right? So in many countries you have fairly high tax rates, but people are relatively happy with it because most of the tax is going back on them. And so, for example, in Japan you have roughly similar tax rates to the United States, but you have very little military spending. So a lot of it goes back into having healthcare be more affordable than we have in the United States. So they spend less per capita on healthcare than we spend, despite the fact that they're on average older. So it would come down, I think, to how happy the society is and how unified the society is around the systems they've built versus how polarized they are, and how unjust they feel that it currently is, what their taxes are going to. If they feel like they're getting their money's worth, you could certainly argue that, if you're not paying income tax, something like a 10% property tax would seem less insane, because just like,
Right.
well, all this other stuff's untaxed, so there's a couple points of high taxation.
Right.
That would pass on to renters in the form of, even if you didn't own property, you'd effectively be paying your portion of tax through your rent, because landlords would have to raise the prices. So you'd collect it in that way. So you could still have a decent amount of taxation in that scenario. I think around the margins, certainly, I think it's harder to get those excess ones when society feels like they're not getting their money's worth at all, because it's easier for them to move something else. And it also, taxes, of course, always shift around incentives, or broken money systems always shift around incentives. And so, for example, I've argued this, since we have weak money, we of course monetize other things. We monetize the S&P 500. We just shovel money every month in the S&P 500, because it's like, well, I'd rather own that than own dollars over 10, 20-year period. Or you buy a second home to rent out. You monetize housing, which of course is really bad for people that actually just want to own one primary dwelling.
Right.
The fact that you monetize it, it makes it harder for them to buy.
Yeah.
In Weimar Germany, right now we're monetizing art, right? So art is a store of value. And in Weimar Germany, they had this extreme like art monetization. And then when eventually that hyperinflation broke, you'd have art values get like cut in half, because there was a certain percentage of the money that was only in there by necessity,
Right.
that went back to more liquid and better money. In the United States, when gold was banned in the 40s, and then the 30s, and then you had all that inflation in the 40s, you had this huge spike in real estate prices in the 40s, because it's like, well, if I'm being financially repressed but I'm still allowed to buy real estate, I guess I'll buy real estate. And the money supply allowed just all the nominal value of that real estate went up quite a bit, so you had asset price inflation. And so changes to how money works certainly changes where we want to store value. And so if you had more property taxes and more excise taxes, yeah, that would probably restrain things like second homes. It would reduce the monetization of real estate, and we would increasingly just view that as a utility. And we would, to the extent we want to live there, we're willing to pay it, but we don't want to have more real estate than we need.
Yeah, and I think that would, I mean, in my mind at least, that would be a reversion back to kind of the purpose of government, if we consider it as just being this security mechanism, the security service that's actually protecting, property, or real property in particular, land, borders, territory. It would seem to make sense that maybe you would just pay based on how much of that footprint you owned that was being protected, versus how much income you're producing and all of this. That, I mean, I guess that government does impact that to some extent, but it seems like it gets largely beyond the value that they're creating for entrepreneurs once they start getting into their income and assets and things like that, versus just paying some kind of like a flat tax on land, perhaps.
Yeah, because once they start, once some percentage of your income is going to sending soldiers over to another continent to do whatever they're doing there,
right,
killing people and building hundreds of foreign bases, things like that. There's this kind of like rank order of things that people would probably put up less if it was harder to, one, if it's harder to dilute money,
yeah,
and then two, if it's harder to surveil and then tax money.
Mm-hmm.
And so they, obviously they'd want police and firefighters and things like that to protect their property, and then they want roads. You can have tolls and things like that. They can collect taxes for them, and then maybe some societies still want healthcare. Maybe they want government healthcare. Maybe other ones don't, depending on their culture and things like that. Maybe they vote for it, they want it, they get it. But very few would say, yeah, let's all pay extra tax this year to go and bomb this other country.
Right.
And so you kind of start going down the list of taking out the most malinvestment and get either some might be more minimal, some might be more moderate,
Right.
but you'd probably get rid of the silliest uses of government funds.
Yeah, no, that's a great point. Just a contraction in overall malinvestment, starting with the most malinvested, which would be warfare, where you mobilize people and capital to go and destroy people and capital.
Yeah.
Great point there. Okay, so I'm going on to page 9 now on the PDF, and this is where they define financial repression, actually. And I'll just read an excerpt here. This is under the heading, The Pillars of Financial Repression. The authors write, the term financial repression was introduced by Edward Shaw in 1973 and Ronald McKinnon in 1973. Subsequently, the term became a way of describing emerging market financial systems prior to the widespread financial liberalization that began in the 1980s. And they say, see Agoner and Montiel, Giovanni and DeMalo. They're just referencing some work here. As we document, financial repression was also the norm for advanced economies during the post-World War II period and in varying degrees up through the 1980s. So again, financial repression, governments sequestering these tax bases to exact the revenues necessary to pay off accumulated debts, largely wartime debts. And the authors go on to talk about this thing I thought was interesting: the creation and maintenance of a captive domestic audience. These measures, I think, really highlight the anti-capitalistic nature of this whole thing. Like, a free market or a free economy is premised on this open form of free exchange, and people should be able to move their capital and build businesses and let the businesses fail, see which ideas work, which ones succeed in the market, which ones fail in the market. We all learn collectively, we get more productive, we go forward. But this whole thing, this whole discharge of this debt structure requires erecting artifice that inhibits that. It inhibits the free market. It's kind of self-defeating in a way. So, I'd love to just hear your thoughts about this. It really seems like in this sort of, a lot of what the government's saying they're doing is supporting capitalism or supporting free trade or supporting the economy or whatever. But in reality, a lot of their measures end up really attacking the market itself. And I don't know exactly what I'm trying to say here, other than it seems to be like a self-defeating effort.
One of the most subtle things is the price controls on money itself, right? So most people would agree that price controls aren't very effective at
Right.
doing what they're doing. Like, so let's say you have a spike in oil prices in some state. Let's say there's a state, a pipeline broke, they're out of gasoline, and so gasoline's in short supply. So gasoline in that state spikes dramatically. That is like a signal to everyone in the nearby states that has gasoline in one way or another. It incentivizes them to go and bring gasoline to that state.
Yeah.
And it's uncomfortable because it means that people who, maybe the rich people in the state can afford gasoline and poor people can, or it means that people that absolutely need it, hospitals are just going to pay whatever they need, whereas a liquor store might shut down, whatever the case is. So you go from most important to least important, and you go from rich to poor. And so in some ways it could feel unjust, but the alternative is if you do price controls in that state and say, okay, no one can charge more than $2 a gallon for gasoline, then it reduces the flow of external gasoline into that state because it reduces the incentive. And the bigger the gap, if gasoline goes to $20 a gallon, the further states away are still incentivized to come. So that the bigger that gap gets, the stronger the incentive is, and the wider the number of entities around that region are to come and bring gasoline and fix that and get that resolved by market forces. And so price controls have one of those things where you can use rhetoric to make them sound good, but then in the long run they backfire. And we've been in an environment, again, I would argue in large part due to the order technology, where we have price fixing of money itself, and it's actually really hard to measure all the impacts that has throughout society because we can direct things. And then the other argument, going back to how much is market forces versus government, you can argue that to the extent that a government is voted in, that they're basically voted in to do some longer range things that is hard for individual businesses to do, either because of physical realities or scale. And so, for example, the companies that ran the undersea fiber optics cables, they went bankrupt. The companies that dug the English Channel went bankrupt. And it's it's almost like we're lucky they didn't know that ahead of time, or they wouldn't have done it, because obviously those things were that infrastructure is really hard, especially massive infrastructure is really hard for private entities to do because it's at such a scale, and these business cycles kind of last 5-10 years, and then if your thing takes 30 years to pay off, how do you calculate that? And so you just decide not to do it. And so you can argue that one of the best examples of public funding was what Eisenhower did in the 50s, which was the interstate highway system. He learned from his experience as a general that this is something that will actually it's hard for individual companies to do at this scale. We can do it, and we can it's a shared resource that'll make all private businesses more productive now. And so that's the platonic ideal of government, where you say, okay, there's certain things that don't pay off for 10, 20, 30, 40 years, or that there's scale that there's almost no entity that's willing to take on that risk, and so we can pool our risk together to do something. And so that's the Steelman case for that purpose. And there are really good examples of it. Of course, it's power corrupts, and so when you have that capability, it's easy for it's easy over time for the first rulers to that get voted in to use that power well,
justly.
and then over time you get other presidents that misuse that power, other Congresses that misuse that power, and it degrades over time, and frictions build up and corruption builds up. And then of course you pass these 2,000-page laws that are just filled with pork, and filled with okay, you want this once they want to pass, say, child care tax credits, and then I want my museum in my jurisdiction funded for this exhibit, or this all these little details that are sewn on. It's like, well, I want to build tanks in my jurisdiction that the generals don't even want. They said they don't even want more tanks, but I want to give my workers in my state, more jobs to build
Jobs,
tanks.
yeah.
So we're going to add that. And so that's where you get the more the graft,
Yeah.
what is often the realistic form of government, but that, there's still a case for voted in officials trying to do long range things. And the question becomes, what are the constraints on them? How to limit those constraints so that they're actually solving the handful of problems that might be hard for private businesses to do, rather than the bigger scale of corruption, wars, and graft and
Right.
things like that.
Yeah. I mean, perennial problem is once you give an authority that power that may be used justly in the beginning, as you said, how do you ever take it back? You just, right. Then what's the old saying? There's nothing more permanent than a temporary government program. It's like once
Yeah.
it's in place, it's just there forever. How much? So to double click on that infrastructure point, that private enterprise has a harder time with these large scale infrastructure projects. And I think you said that's kind of a calculation problem. How much do you think of that is due to the fiat exacerbated business cycle itself, that they can't engage in super long term economic planning because we've amplified the uncertainty of the business cycle through currency debasement? Do you think in a world where, again, this hypothetical platonic ideal world of, say, a Bitcoinized world, you in theory would have much more predictable or less violent business cycles? Do you think that would enable private enterprise to engage in longer term planning for larger infrastructure projects?
It's challenging to say for sure, because we always have some mix of private enterprise and governance. I mean, like I said, governance it fills in vacuums wherever it finds it. So
Yeah.
when you go back in history, there's always this mix of private enterprise and then either authoritarian government or voted in government, which is another will of the people. And even if you look at, say, free banking eras, you still have cycles. And so you can argue that it's just, one is the cycle, it's the calculation problem, and then two, it's also the scale. So there's economies of scale that come with, being able to plan 20 years ahead, or be able to do something at a scale that's very hard to coordinate, at anything smaller than, say, a government level, or maybe the biggest three companies in the country, right? So there's a very small number of entities that might be able to do something that's particularly hard to do, or particularly just capital intensive to do, or that involves things like where to place roads, and so you need some sort of organized coordination of, like, where is this going to be, who owns this land, and to go from there. So I think that some of it's intrinsic, but that by influencing the price of money, and by, you know the Fed always overshoots, for example. Central banks overshoot, they undershoot, they overshoot, so they exacerbate in many ways the business cycle. And then they tighten liability, they encourage debt accumulation, and then when it gets out of hand, they tighten that debt accumulation. And so they encourage, it's like they encourage people to overdrink, and then they give them the keys, right? And then
Right.
so
Yeah.
so that part doesn't mix well, and if anything, that's not a good mix. But some of it I think is intrinsic, and that's why, I mean, one reason I like Bitcoin is because encrypted money is asymmetric, in the sense that it gives individuals more choices, more self-sovereignty, for lack of a better word. And then they have more say on the governance that they want. And so, I don't always know the right mix of governance. I might have my own opinion or not another opinion, and I think I think there's not one right answer. The right government for Norway might be a different right government for Singapore, might be a different right government for the United States. Um, but that the more empowered individuals are, the more they have, the ability to live in the region that they want to live in. And I especially think about that. And again, going back to the 50% of, over half the world lives in authoritarianism. and bad money systems. And so to the extent that technology can go out and give people more, kind of self-control of their finances, which then increases their options. There's still physical constraints that they have to deal with,
Yeah.
but at least having financial resources increases your options and your probability of being able to shape the world around you the way you
Mm-hmm.
want. And then they can, either shape their local area more the way they want, or they can move out of that area. And so there are a lot of good philosophical questions about the role of government and this kind of dance between private enterprise and governance, and the fact that just you might have a platonic ideal of something and then the reality of that thing, or just the reality of incentives and how human behavior works and how governance just kind of fills in vacuums. But that technology that at least limits it, or at least empowers people to choose the form they want, is something I support. And then, I don't always know the right answer, but if people choose it,
Right.
I'm less, I'm like, who am I to argue?
Yeah, just technology that enables government to be constituted more by market forces rather than authoritarianism, right? The opinion of one
Yes.
guy or guys or
Yeah.
whatever it may be. That makes a lot of sense. I think that would be pretty universally attractive for most people in the world, except those few authoritarians, perhaps. It's a great point there. I want to read one more excerpt, and maybe we can close on this because then we jump into a whole nother category. So, still under this pillars of financial repression and defining financial repression, the authors write, the creation and maintenance of captive domestic audience of a captive domestic audience that facilitated directed credit to the government. This was achieved through multiple layers of regulations, from very blunt to more subtle measures. And they enumerate these A, B, C, D. A, capital account restrictions and exchange controls orchestrated by a forced home bias in the portfolio of financial institutions and individuals under the Bretton Woods arrangements. B, high reserve requirements, usually non-remunerated, as a tax levy on banks. Among more subtle measures, C, prudential regulatory measures requiring that institutions, almost exclusively domestic ones, hold government debt in their portfolios. Pension funds have historically been a primary target for this. And finally, D, transaction taxes on equities also act to direct investors towards government and other types of debt instruments. Oh, and there's an E, prohibitions on gold transactions. I'm sorry. This last point's important too. They go on to say other common measures associated with financial repression, aside from the ones discussed above, are A, direct ownership, as is done in China and India, of banks, or extensive management of banks and other financial institutions, as is done in Japan, and B, restricting entry into the financial industry and directing credit to certain industries. That might be the directed credit we talked about earlier.
Yeah.
One of the, key points I take from this is that, again, there's a difference in degree, but not kind, between China and the US, right? Whereas we often tend to think like, oh no, we're the United States, we're free market capitalists, we do all these things totally different. China's a whole another animal. They have this whole other, they're built on an entirely different philosophy and a totally different model of statism. But that's not, in fact, the case. These are both models of statism, business models of statism, but one's using different, more aggressive means, perhaps, and one's using less aggressive or less obvious means, perhaps. But the difference is in degree, not kind. I think that was a key insight for me. Do you think about that in the same way? Like how do you, I know you just said that there's no right government for anyone anywhere, but what is it almost seems like an ideological possession, perhaps, where people think, oh no, we're the United States, we're fundamentally different than China. But that doesn't appear to me to be true. I would just like to hear your thoughts about that.
So I agree. I think there's pretty much every economy we look at, other than maybe the most extreme cases, is a mix of private market and then some sort of government overlay onto that, which in the ideal case represents, some sort of safety net or voted overlay on what people want in addition to their commerce, rather than all, kind of top down given. And yeah, go back to the point of that there's no right government. I would phrase that as there are objectively right or wrong answers to government, but then there's also areas that there's multiple local high, there's multiple local maxima, and it's hard to determine which ones are best, and that they might just be due to geographic differences, cultural differences, population size differences, natural resources differences. And so the analogy you can use is nutrition, right? There are objectively wrong things to eat. If you eat poison, it's bad for you. If you eat tons of processed foods, it's bad for you. But then due to your genetics or due to some details about you or how athletic you are or what you want to do with your body, there might be different diets that are hard to say which one's better.
Right.
Because there's multiple right answers, there's multiple wrong answers, but there's not necessarily one right answer for everybody in the world.
So it's a
And
matter
that's
of
how
fitness, like it's fitness in the Darwinian sense, right? There's going to be different, more fit and less fit governments for different cultures or areas.
Yeah, there are multiple. I think there are multiple right answers, multiple wrong answers, and there's a spectrum of ones that are hard to say which one's better. And most economies we know of have basically, you need to be able to be, if they're successful in any way, basically they have the ability to start a business, operate relatively freely, and then inevitably there's some degree of higher coordination that determines what are the laws and what are some of the basic rules we're going to go by, and then to the extent that they incorporate fiscal spending, there's usually some sort of shared pool of fiscal spending that they do, and some of them have a pretty large percentage of their economy, and some of them have a pretty small percentage of their economy, but it varies. Mostly it's a matter of degree rather than kind. With political systems itself, you can get a somewhat of a different kind. I mean, there's a difference between a place where they just don't vote versus a place where they do vote. But even among places you do vote, there can be a spectrum where, your vote is fairly counted versus places, a lot of countries vote, but then, there's ways to manipulate the votes. Right. And so Kim Jong-un is voted into office, but we all know it's not a real vote. Right. So there are differences in kind, but then there's also a spectrum of how fair and free are those elections, and how widespread is the voting. I mean, in a lot of societies, including a lot of American history, white propertied men could vote. And the same thing was true for ancient Greece. I mean, we think of those as the early republics, but it's like they had huge slave populations, and it was basically the wealthy would vote. So even among voting cultures, there's a spectrum. I mean, how old are you?
Right.
What are the qualifications to vote? And so there are, I think, different answers for that. Kind of over just and changing technologies determines in some ways what things work better than others. So you could argue that, for example, literacy and communication systems were a key ingredient to make a republic possible to operate.
Right.
And then you can argue that to the extent that if money catches up in speed to commerce, that opens up new forms of governance that or makes governance that didn't work before more workable.
Right.
And so technology is always an ingredient into what types of, in the real world, what types of governments actually exist and, are fit relative to others.
Yeah, if you had an illiterate society, you couldn't have voting at all, really, right? Because they at least could not go into a voting booth and choose from something written. So that makes a lot of sense. That there's a lot of considerations. I guess the connection maybe between that I was drawing here was specific to the financial repression, in that maybe I could say like this, that all the governments in this study at least are financially repressive, engaging in some form of financial repression. It's just on a spectrum. Again, a few different types, but there's also more extreme and less extreme forms of that. And yeah, I get just the idea that governments in general, this seems maybe part and parcel to their function, is that they have to be repressive to some extent. It's almost in the nature of the word itself, right? To govern or to regulate, right? To not let something just flow freely. Even I'm thinking of like a governor on a car, right, where it limits your top speed, and you can remove the
Yes,
governor and go faster. But
exactly.
is that good? Is that
And
bad? I don't know.
and it both limits, but also, I mean, let's say someone has someone else as a slave and the government comes in and says you can't do that. So
Mm-hmm.
it can technically give freedom, but also in
Yeah.
many cases takes it away. And going
Right.
back to the financial repression analogy, or the kind of the focus that we're on, is that the more those repression systems can be tied into a narrative that makes sense to people, the easier they are to enforce because they're less
Okay.
friction.
Yeah.
And
Right.
an example would be making banks have higher reserve requirements.
Mm.
And the reason, so both of those were enacted, right? So in the 40s, if you go back to a time, if you look at the percentage of bank assets that are in treasuries in the United States over a very long period of time, you would see that the highest points are right now. And then prior to this time, the 1940s and shortly thereafter, the 50s, and which are the two times where federal debt as a percentage of GDP was well over 100%. And they also occurred in like the decades after major financial crises. So going into the subprime mortgage crisis, banks had a very, very small percentage of their assets in treasuries, and a very high percentage in housing loans that
Mm-hmm.
blew up. And so they had very little margin of error when they blow up. Um, partly that was encouraged by, the Fed cut rates to near zero. They
Mm-hmm.
encouraged all this speculation in real estate. And then you had Wall Street collateralize the loans. So you broke the
Mm-hmm.
incentive structure of keeping the mortgage on your own balance sheet and making them opaque. So it was hard to manage risk. And then you had credit rating agencies stand to a AAA. So you had multiple public and private sectors kind of merge into cronyism and make this like, bound to blow up.
Right.
But going into that crisis, you had, banks had very little treasuries. And then they say, okay, well, they all blow up. We had to recapitalize them now. And so now we're going to have a rule that they have to have at least, X percentage of their assets in bank reserves and treasuries. And on the surface, that makes sense. You say, okay, we don't want to bail these things out again, so we're going to make them hold more. But by extension, they're also monetizing government debt more.
Mm-hmm.
And so that's like one of those things you kill two birds with one stone, and few people are going to object to that. It doesn't. You're not saying we're going to make banks hold more treasuries because we need the financing.
Right.
Instead, they're saying we're going to make banks hold more treasuries so that they're safer. And you go back to the 40s, the last time they actually even higher treasuries back then as a percentage of their assets. And of course, that came in the aftermath of the 1929 crash. That's when they created FDIC insurance, and then that's when they put in the Glass-Steagall Act, and then they said, okay, investment banks are separate than normal banks, and that banks have to hold a lot of reserves and treasuries. And so when they tie those narratives together, that's how they make this work with somewhat less coercion, with less
Right.
extreme coercion, because to the extent that people buy into it and it makes some sense on some level. But then at the end of the day, they always combine it with some stick, and the stick was you can't own gold in this
Right.
case, right? So in the United
Right.
States, it's like, you did a lot of nice things that, they're like, hey, like buy war bonds for the country, and hey, we're gonna make the bank safer, and hey, we're gonna, but then,
Mm-hmm.
the kind of the unmasking the
Right.
more strict form was we will put you in jail if you own gold though.
Right.
So so yeah.
This is yeah, I guess maybe the unerring hallmark of government action is that no matter what they do, it's always for your safety. Right? No matter I everything, right? Everything you just described, whether it's financial or physical or a mask mandate, it's always, no matter what they do, they say they're doing it for your safety. And that just seems to be like a slippery slope because you can sweep under anything under that rug. Um,
And that's where having rule of law and various constraints, at least try to push back on some of that and bound it into, the minimalist form as possible.
yeah.
And so the more educated a population is, the more empowered they are financially, the more likely they can say, call out bullshit when they
Right.
see it versus, go along with whatever's happening at the time.
Yeah. Brilliant point. I think this is a good place to stop for today because we're about a little over halfway through this. Well, a little over halfway through the halfway that we planned on getting to today. So more like a quarter. Lyn, I really enjoyed this conversation. I look forward to continuing it. Do you want to just let my audience know where they can find out more about you or your work?
So I'm at lynalden.com. I provide a lot of public articles about financial topics, including some of the stuff we touched on here. And I'm on Twitter at Lyn Alden Contact.
Beautiful. Thank you so much.